You know, it's actually kind of fascinating how the human brain is practically hardwired to sabotage us when money is on the line.
Oh, absolutely. It's like we can't help it.
Right. I mean, think about a casino. Everyone always remembers that one guy who hits the jackpot on a slot machine. They see the flashing lights, they, hear the sirens going off, and they instantly think, well, I could do that.
Yeah, they get completely sucked into the spectacle of it.
Exactly.
Yeah.
But they completely ignore that quiet, windowless room upstairs where the house is just methodically and completely unemotionally grinding out a statistical edge.
Because the house isn't gambling.
Yeah.
I mean, the amateur's relying on hope and the sort of illusion of control. But the professional, they rely on math. They rely on survival, really.
Yep.
And in the financial markets, crossing that divide, like going from amateur to professional, it's really the only way to avoid becoming someone else's liquidity.
Which perfectly sets up what we're talking about today. Welcome to Bitcoin Deep Dives by MyCryptoParadise. Today, we are bringing you straight into the inner circle, analyzing a critical market update from our very own Paradise team trader, Simon.
And this is a big one.
It really is. We aren't just looking at, some technical charts today. The mission here is to really deconstruct that mathematical divide between professional trading and amateur gambling.
Right, because everyday retail traders consistently lose in the long run, even if they get lucky for a week or two.
Exactly. And we're going to use Simon's brilliant data analysis to expose the behavioral traps that are hidden in the Bitcoin market right this very second. So let's just get into it.
Yeah, let's do it. So to really understand that professional mindset, you first have to look at what the emotional amateurs are doing right now.
The ones making all the noise.
Exactly. And according to Simon's data, there is a massive structural trap forming, like right now.
So let's talk about the bait for this trap, because it's pretty compelling if you don't know what you're looking at.
Oh, definitely.
Simon points out that the retail market, specifically futures traders, they've been buying super aggressively, using heavy leverage. And they actually pushed Bitcoin up toward that, what was it, $79,473 mark?
Yeah, roughly 79.4K. But the update notes that these exact buyers are now trapped completely underwater.
Right, and the mechanics of that push are so telling.
They really are. Because if we look at the cumulative volume delta, which is basically just a metric that measures the net difference between buying and selling pressure, it shows that this recent rally was almost entirely driven by leverage.
Just people borrowing money to amplify their bets?
Exactly. Retail traders anticipating just an endless upward continuation. But the price slipped below their average entry point. So now they're holding these leveraged contracts, their accounts are just bleeding out, but they haven't sold yet.
They're just praying for a bounce.
Right. And open interest isn't climbing, so we know new capital isn't coming in to save them. But these trapped buyers haven't capitulated.
And meanwhile, if you look at the spot market, the actual whales, the smart money, they are executing the exact opposite strategy.
Yes, they're actively distributing.
Wow.
While retail is clinging to hope, the smart money is quietly selling off their spot coins. It's wild. The tiny minority that manages the vast majority of the capital is systematically handing off their bags to retail traders who are just blinded by greed.
Okay, I'm struggling with this a little bit, though, because if you look at the timeline right now, the sentiment is incredibly greedy.
Oh, extreme greed.
Right, so doesn't that sheer momentum kind of force the price up naturally? It feels like getting onto a crowded elevator where everyone suddenly rushes to one side. Shouldn't the sheer weight of all those buyers just tilt the market upward?
Well, the elevator tilts, sure. But what happens when the cable is under too much stress from all that concentrated weight?
It snaps.
It snaps. And in financial markets, institutional professionals, they don't look at a crowded elevator and decide to squeeze in with everyone else.
Right, they aren't following the herd.
Exactly. They look at the stress on the cable. They look for the path of least resistance. And right now, the liquidation heat map is showing a terrifying structural imbalance.
Okay, let's put some hard numbers to that stress, because this blew my mind when I read it.
Yeah, if you zoom out to a 30-day macro perspective, there is $11 billion in leveraged long positions.
Wait, 11 billion?
11 billion. Just sitting there waiting to be liquidated if the price of Bitcoin drops toward the 67,000 level.
That is insane.
And by comparison, if the price pushes up toward 86,000, which is roughly a similar percentage move, there are only 2.8 billion in short positions waiting to be liquidated.
So 11 billion to the downside versus 2.8 billion to the upside.
Yep. The path to least resistance is painfully obvious.
Mechanically, though, How does an institution or like a market maker actually exploit that 11 billion? How do they trigger the snap on the elevator cable?
So think about the biggest problem a whale faces, right? Slippage. If you manage hundreds of millions of dollars and you want to sell, you can't just dump that on the open market.
Right. There just aren't enough natural buyers at that exact second.
Exactly. So your own massive sell order would crash the price before your transaction even finishes filling. You'd ruin your own profit margin. You need forced liquidity.
And the trapped leveraged longs, they provide that forced liquidity.
They are the ultimate sitting ducks. So here's the step-by-step. An algorithmic trading desk sees that massive cluster of 11 billion in liquidations sitting just a few percentage points down.
Okay.
So they deploy strategic sell orders, not dumping their whole portfolio, just enough to nudge the price down a few $100s.
Just a little push.
Right. They push the price right to the edge of the first major batch of margin calls.
And just so we're all on the same page, a margin call means the trader's account equity has dropped too low to keep their borrowed position open, right?
Yes. The exchange steps in automatically. The exchange basically says, hey, your account is out of money. We are closing your position to protect our funds. And to close a long position, the automated system has to execute a market sell order.
Oh, wow. So that first batch of liquidated traders is forcefully acting as sellers.
Exactly. And that automated selling pressure pushes the price down even further.
Which pushes the price perfectly into the next batch of liquidation levels.
It's a self-sustaining avalanche. The exchange is forcefully liquidating accounts, driving the price down further and further. And the institution that started it all, they don't have to do anything else.
They just tip the first domino?
They tip the domino, and the forced liquidations carve out a massive red candle straight down the chart. Then the institution steps into the bottom and buys back their coins at a massive discount, using all that fresh panic-selling liquidity.
That is so ruthless.
It is. But hunting that 11 billion downside requires significantly less effort and capital than trying to fight the uphill battle to liquidate the 2.8 billion in shorts. It's just math.
Wow. Okay, so we've established how fragile the downside is. But if we look at the top of the chart in Simon's update, there is a $430 million block of sell orders sitting right at 80,000.
Yes, the wall.
Right, the wall. And it's tempting for people to brush that off as just spoofing, you know, like some whale flashing a fake order to spook the retail bots.
And spoofing does happen constantly in crypto. We all know that.
Right.
But Simon uses historical order book data to verify that this specific $430 million wall, which actually swells to $600 million sometimes, is a genuine structural barrier.
So it's not fake.
Not at all. First off, it aligns perfectly with long-term technical resistance levels. It makes structural sense for a massive seller to defend that exact price point.
Right. They have a reason to be there.
Exactly. And second, this order hasn't just flashed on the screen for 2 seconds to cause a panic. It has been sitting there consistently for a significant period. It's a titanium ceiling.
Okay, so Simon's update frames this whole structure, the unbreakable wall above at 80K, and the trapdoor below with the liquidations as part of a, quote, breathing organism.
Yes, I love this analogy.
It's a great analogy. He references an Elliott wave structure to explain this macro view, and I see Elliott waves referenced on crypto Twitter constantly, but what is the actual psychology driving it? Is it just like an arbitrary pattern people draw, or does it actually map human behavior?
It is pure crowd psychology visualized on a chart. The theory basically dictates that markets move in 5 distinct waves in the direction of the main trend.
Okay, walk me through the waves.
So wave 1 is quiet accumulation by the smart money. Nobody in retail is paying attention. The news is probably still bad.
And boring.
Very boring. Then wave 2 is a minor sell-off. Those early buyers take a little profit, causing a small dip.
But it doesn't crash because the foundational support from the smart money is still there.
Exactly. The floor is solid. Then wave 3 hits. And this is typically the longest, most aggressive wave.
That's the fun one.
Oh yeah, the fundamentals look great. The news cycle turns overwhelmingly positive, and the broader retail crowd starts flooding in. They don't want to miss out.
Right.
Then wave 4 happens. It's usually a messy sideways consolidation. People are confused, some are taking profits, others are holding on for dear life, and the momentum just sort of stalls out.
Okay, and then finally wave 5.
Wave 5 arrives.
And I imagine wave 5 is where that casino mentality takes over entirely.
It is pure, irrational exuberance. The fundamentals no longer support the price, but people are buying simply because the chart is green. Leverage is maxed out. Every guy on the internet thinks he's a genius.
So that five-wave structure constitutes the complete inhale of the market organism.
Exactly. A massive breath in. But once wave 5 exhausts itself, the market fundamentally has to correct. It has to exhale to reset the balance.
You can't just hold your breath forever.
Right. And Simon's analysis of the current structure indicates we've completed that massive cyclical inhale, and the market is preparing for a heavy, necessary exhale.
And the target for that exhale is down to the $44,000 zone.
Yes.
I mean, dropping from nearly 80,000 down to 44,000 sounds absolutely apocalyptic for anyone heavily invested right now.
It really does. But Simon makes it very clear this isn't just a random pessimistic number he pulled out of thin air.
Right. So why is that 44,000 to 55,000 zone so mathematically crucial?
Because it represents the historical exchange of hands zone. It is the ultimate pain threshold for the market.
Pain threshold meaning what exactly?
We saw this exact mechanism play out in the previous cycles, like in 2019, 2023. At 44,000, it is no longer just retail traders getting liquidated on Binance futures. This is the zone where Bitcoin miners, the actual institutional backbone of the entire network, are forced into capitulation.
Oh, right. Because mining isn't just plugging a graphics card into your bedroom wall anymore. These are publicly traded companies with massive overhead.
Huge overhead. Industrial mining operates on razor-thin margins. They take on immense corporate debt to purchase these cutting-edge ASIC mining rigs, and they have staggering monthly energy bills.
Yeah, gigawatts of power.
So when the price of Bitcoin drops into that 44,000 zone, the cost to mine a single Bitcoin actually exceeds its market value. Their profit margins flip negative.
Wow, so they are literally mining at a loss. They are forced to sell just to keep the lights on.
Exactly. They have to sell off their newly mined coins immediately. They have to liquidate their treasury reserves.
Yeah.
And the most over-leveraged companies, they actually have to sell off their physical hardware and declare bankruptcy.
That is brutal.
It flushes the weakest institutional players out of the market entirely. But simultaneously, the strongest players, the smart money with deep cash reserves, they step in to accumulate at those depressed prices.
So that massive transfer of assets from weak hands to strong hands, that's what absorbs the selling pressure and creates a true durable market bottom?
Exactly. It forms the bedrock for the next cycle.
But how do you verify when that pain threshold has actually been reached? Because human nature makes you want to jump back in the second the price drops 10%. You think, oh, I'm getting a discount, I should buy now.
And that's how people catch falling knives. Professionals, they rely on-chain data, specifically the Adjusted Net Unrealized Profit and Loss Chart, or NUPL.
NUPL, okay.
Yeah, NUPL. This metric tracks the unrealized losses held by all market participants. It calculates the price every coin last moved at on the blockchain and compares it to the current price. So it effectively maps the network's collective pain.
Wow, so it shows you exactly how much blood is actually in the water.
Precisely. To form a major cyclical bottom, you mathematically must see a period where institutions and long-term holders are pushed into deep, unrealized losses. The chart needs to plunge into the red.
And where are we now?
Well, as Simon points out in his update, looking at the data right now in 2026, we simply aren't in those heavy red numbers yet. The collective pain just hasn't reached the critical mass required for a structural reset.
So if a back-tested strategy takes years to play out, and a true market bottom requires extreme patience to wait for that NUPL data to align, it feels like the biggest threat isn't even the market itself. The biggest threat is the trader just getting bored.
Oh, boredom is a massive portfolio killer.
Right. Like, how do you stop someone from abandoning their discipline the second they feel like they're missing out on some temporary pump?
You have to systematically dismantle the God complex.
The God complex.
Yeah. Simon has a golden rule. Risk first, profit second. Amateurs, they only calculate how much they stand to win. They catch a lucky wave, go from 0 to 100, and suddenly they believe they possess some innate intuition for the market.
Right. They think they cracked the code.
Exactly. But because they lack a discipline system, the very next inevitable correction just crashes them right back to zero. A professional trader looks at a setup and asks, if this goes entirely wrong, will my portfolio survive to trade tomorrow?
Boring is profitable.
Very boring. A legitimate strategy isn't about catching every wild swing. It's about identifying a statistical edge. And Simon emphasizes that any legitimate strategy must be back-tested over at least 3 years of data.
Why 3 years specifically? Is there a magic to that number?
3 years forces your strategy to survive all phases of a macroeconomic cycle. It has to perform through aggressive bull markets, grinding bear markets, and sideways, choppy consolidation phases.
That makes total sense.
Right, because a high-leverage breakout strategy might look like pure magic during a Wave 3 bull run.
Yeah.
You're printing money every day.
Right. Everyone's a genius in a bull market.
Exactly. But that exact same strategy will bankrupt your entire account during a sideways market where breakouts constantly fake out and reverse. You have to know mathematically that your system possesses a net positive edge across the entire timeline, regardless of the daily noise.
Which brings up the real psychological challenge of sticking to that system. This is where the behavioral science part gets really fascinating to me.
Yeah, it's my favorite part.
Simon compares a trader's relationship with the market to actual human relationships. He uses this analogy of the one-night stand versus the marriage.
It is brilliant. It perfectly isolates the emotional disconnect that ruins most traders.
Right. So break that down for us.
So an individual trade, a single entry and exit on the chart, is a one-night stand. You should have absolutely no emotional attachment to it whatsoever.
None.
None. You execute it based on your parameters. You take the result, whether it's a win or a loss, and you move on. You do not let it validate or destroy your self-worth.
But your overall trading strategy, that's the marriage.
Exactly. Your trading strategy is the system you have painstakingly backgested for 3 years. You must be completely loyal to it. You follow its rules with absolute unwavering discipline. And most importantly, you cannot cheat on it when times get tough.
Oh, wow.
If your system hits a statistical losing streak, which, by the way, all valid systems do, and you panic, abandon your rules, and switch to a different strategy you just saw on social media, you are cheating on your marriage.
You're abandoning your edge.
Yes. You immediately forfeit the long-term statistical edge you spent years building.
That totally shifts the blame. Like, we usually blame the market for a loss. Human nature makes us obsess over the outcome of a single event.
Always.
We obsess over the one-night stand. And if a trade hits our stop loss, we feel like it's a personal attack from the universe. We get frustrated. We try to revenge trade to win the money back instantly. But in Simon's framework, a loss is just a business expense.
That's all it is.
The only real failure is abandoning the system.
That is the dividing line right there. Amateurs trade to feel excitement. They want the dopamine rush of the gamble. Professionals trade for survival. To a professional, a loss is not an insult to their intelligence.
It's just data.
It's just unemotional feedback that proves their risk management is actually working. As Simon outlines, losses are the cost of doing business, and wins are simply the mathematical result of executing the system over thousands of iterations.
It fundamentally changes how you view a red candle on a screen. You aren't looking for a thrill anymore. You are managing a highly structured business.
Precisely.
So when Simon states he is bearish on the immediate time frame right now, it isn't because he has an emotional vendetta against Bitcoin.
Oh, not at all. He fully expects the next macro-cyclical inhale to carry the market toward new all-time highs. We're talking potentially up to 169,000.
169K. Wow.
But he respects the structural timing. He refuses to utilize bullish tactics when the liquidation heat map, the Elliott wave structure, and the on-chain data are all screaming that the market is currently setting a trap.
He is waiting for the data to shift. He wants to see that 80,000 resistance definitively flip into support, and he wants the NUPL data to prove that institutional reaccumulation is actually occurring.
Yes. By respecting the risk first, he ensures he will actually have the capital to capitalize on the run to 169,000.
While all the retail traders blindly buying with leverage at 79,000 will be completely wiped out during the cascade down to 67,000. Simon's approach just entirely strips the chaos out of the chart. It removes the panic, the fear of missing out, the God complex, and the eventual despair.
Which is the goal.
It really reinforces the core ethos of our community here at MyCryptoParadise. We aren't here to gamble. Capital protection is the foundation of everything. We are navigating this living, highly volatile market organism together, relying on hard data and battle-tested psychological discipline.
And honestly, if you do not have a meticulously tested strategy, your default strategy is simply to provide liquidity for the professionals.
Ooh, that is a harsh reality, but it's true. As we wrap up this deep dive into the professional mindset, I want to leave you, the listener, with a final reflection to carry into your next trading session.
It's a good one.
Think about your last painful loss in the market, the one that really stung, the one that made you want to just walk away entirely. What if you genuinely stripped away all the ego, the frustration, and the desire to win that money back right now?
Just let it go.
Yeah. What if you viewed that specific loss strictly as unemotional feedback meant to calibrate your long-term business? How would that fundamentally change the way you look at a chart tomorrow morning?
It replaces fear with clarity.
Absolutely. The next time you feel the urge to jump on that crowded elevator just because everyone else is doing it, remember who is standing by the emergency brake, just waiting for the cable to snap.
Hmm.
Thank you for joining us in the Inner Circle today. Stay disciplined, protect your capital, and we will see you on the next deep dive.